It's easy to get lost when you're looking for your first investment property. How you set your criteria is going to give you a compounding effect in the long term. It could be positive or it could be negative. So you want to make sure you do that right. What's going on, everybody? It's Blandon here from Mortgage HQ. In this video, I'm going to share the framework that you can use when you're looking for your first investment property. This is going to help you make a more informed decision. It's called the 3 C's. First C is capital gains. And when you look at historical data, the larger cities with a consistent population growth and a growing workforce tend to have a higher capital gains in the long run. Now remember, just the population growth alone is not enough. Understanding what age group that is going to help you tremendously on making a better decision. One of my favorite websites to check out this kind of data is figure.nz. It's simple enough for anyone to understand, and they pull their data directly from Stats New Zealand, which makes the information a lot more reputable. Another way to get capital gains is actually buying under market value. This is basically just buying something cheaper than what it's actually worth. And what that requires is a good understanding of that market that you're working in. So running comparable market analysis in that suburb that you're buying is going to be crucial. Now, you also might get a bit of luck if you work hard enough and negotiate on more deals. Some people might just market their property poorly and you're not getting as much competition. Some people might just need some money in a hurry. Some people just don't care about getting the maximum figure that they can on their property. Or simply, maybe you can just give them the terms that they want, which are actually more important than the price for them. So there are several ways that you can buy a property under market value. Second C is cash flow. Now, capital gains is usually the bigger reason why we do investing, but cash flow is what keeps us in the game, and it allows us to use it to borrow more money from the bank. Cash flow is also one of the most important components in a property in this current market, especially when interest rates are sort of sitting in that 4% range. And claiming interest deductions on the existing property is out of the questions at the moment. This actually makes a very small portion of the properties in the market cash flow positive. I do think there's going to be some market adjustment where rental yield have to eventually catch up to interest rates. There's a lot of talk that the government is trying to hold that back, but I think it's inevitable. Now, the properties that usually have a higher cash flow obviously have multiple dwellings on it, usually called home and income properties or multi-units. The other type of property that you might look for is a new build that is a home and income, because those ones you do get a tax deductibility on it, and you got two banks, ASB and ANZ, offering a discounted floating rate of close to just that 2% mark for the next couple of years. This becomes a very attractive investment as well. Third is capital improvement. If you're in a high cash flow position to begin with, you could consider slightly lower cash flow properties because it's got a higher capital improvement value, meaning you can add value to that property by investing more capital into it. This is usually properties with bigger land that you can subdivide or build a minor dwelling on it. Potentially you can extend the house as well. Or you have a very spacious floor plan that you can add multiple bedrooms and potentially add in a suite as well. Now, not all capital improvement properties have low cash flow. Again, home and income multi-units can also sit on a pretty big section that could be potentially developed later on. And personally, I think those properties are one of the best ones to start with because you get a balance of capital gains and cash flow. One of my favorite deals last year was a Mount Wellington home and income that was bought at 1.45 million. It's got 2 times 3 bedrooms on it, and the total rent that you're getting per week is 1,200. The client bought that under market value by about 200,000, so that's instant equity. It's also got the potential to actually build 6 terrace housing on it. These are a mixture of 3 and 4 bedrooms, so they would sell on a higher price. While it is a slightly negative cash flow property based on the current interest rate and the current interest deductibility rules, the capital gains potential and the capital improvement value outweighs this. Of course, this is assuming the person can actually chip in $10,000 to $20,000 per year if interest rate were to go up even more. However, it is important to note when you are faced with this type of situation where you got $10,000 to $20,000 negative cash flow, you can actually mitigate this risk by getting a revolving credit account. Basically, it's an overdraft account that's going to allow you to bridge that cash flow period until you can up the rent or interest rate comes down again. So there you have it, folks. If you have found value, please smash the like button for the YouTube algorithm. Again, the 3 C's: cash flow, capital gains, and capital improvements. If you put this down on paper and actually write down the value of each of these C's on that property, it's going to allow you to make a better informed decision. It's going to allow you to measure your opportunity cost. So until next time, I'll see you guys in the next video.